Welcome to today's Explainer, where we are breaking down a massive, high-stakes macro tug-of-war that is completely gripping global financial markets right now. Today's daily market snapshot brief is all about a really fascinating dynamic. We've got surprisingly resilient economic data pulling hard against escalating geopolitical chaos. Here's our roadmap for today. We'll start with the Market Balancing Act, move on to why all eyes are on the ECB, map out the oil and geopolitical risks, track global currency movers, and wrap things up with a rapid-fire daily market snapshot. Alright, Section 1, the Market Balancing Act, resilient data versus geopolitical chaos. So right now, we are watching these opposing forces basically paralyze global financial markets. It's a surprisingly calm state, but let me tell you, it is incredibly fragile. On one side, we have surprisingly strong economic data, pushing central banks to stay super aggressive. And on the flip side, that force is pulling directly against the absolute chaos of escalating conflicts in the Middle East and tightening energy markets. Investors are walking a tightrope, carefully balancing these two heavyweights. And, eventually, one side is going to pull the other right over the line. Moving into Section 2, all eyes on the ECB. Words are weapons. The European Central Bank completely dominates today's calendar. But look, the real focus here is on President Christine Lagarde's forward guidance, not necessarily some surprise immediate action. The magic number today is 2.25%. Policymakers are widely expected to just leave the European deposit rate completely unchanged right there. But here is what's actually really interesting. Markets have already priced in a massive 73% probability of a September rate hike. That implies nearly 2 additional rate increases by year end. So the ECB's main job today, it isn't actually to hike, it's to preserve this pricing without pushing back against it. Which brings us to the buzzword of the day, hawkish, because long-term Eurozone inflation swaps are anchored so tightly near that 2.2% target, traders fully expect the central bank to maintain a hawkish stance. Basically, they need to reiterate the policy remains strictly data-dependent and that they are ready to step in and tighten things up if inflation pressures stick around. Up next, Section 3. Oil and geopolitical risks, the disruptor. This perfectly illustrates the ultimate disruptor in our market tug-of-war. We're tracking a very clear, very brutal chain reaction right now stemming from the ongoing conflict involving the US and Iran, along with those reported Houthi strikes on Saudi shipping. First, regional conflict disrupts energy supplies. Second, that directly drives up oil prices. Third, those higher prices fuel global inflation. And finally, that forces central banks into a tight corner, which ultimately ends up slowing down global economic growth. Now, despite these obvious red flags, market analysts are actually issuing a stark warning. They're saying financial markets appear surprisingly complacent considering the geopolitical backdrop, and they are right to warn us. This current market calm, it might be incredibly fragile. A failure to de-escalate soon could trigger a massive flight to safe haven assets. Let's move to Section 4, Global Currency Movers, the battlefield. This is the literal battlefield where all this macro tension is playing out in real time. And let's start with a massive shocker from down under. Australia delivered the day's biggest surprise by adding a blowout 76,000 jobs in June. To put that into perspective, it was an immediate reaction, and it's practically forcing markets to price in another potential rate hike from the Reserve Bank of Australia before the year ends. Meanwhile, over in the UK, the British pound has gained roughly 2% against the euro this summer, but economists are waving a huge caution flag here. They're warning that this rally is built on a really fragile foundation. It's essentially being driven by traders unwinding earlier bearish bets, seeking out low volatility carry trades and inbound M&E flows, not by actual fundamental UK economic strength. Let's actually pause on that term carry trade for a second. Basically, it's a strategy where you borrow at a low interest rate and invest in a higher yielding asset. Right now, investors are loving these higher yielding carry trades globally, even in places like Turkey where the central bank holds rates at a staggering 37%. Because of this global appetite for yield, the US dollar index has remained remarkably stable around 101, which is kind of putting a lid on its traditional safe haven breakout. Speaking of the US, the data calendars stateside is pretty light today. We're looking at weekly initial jobless claims, which are expected to tick up just slightly to 212,000. Roughly speaking, it shouldn't alter the Federal Reserve's current steady path at all. Which brings us to Section 5, the daily market snapshot, where we stand. Let's rapidly lock in where these key global numbers actually sit right now to wrap up this explore. The euro is holding above 1.1400 ahead of that ECB meeting. The US dollar index is chilling near 101. Over in energy, Brent crude is testing $95 a barrel, with WTI approaching 100 on all those geopolitical fears. Gold is consolidating in that $4,000 to $4,200 range, and on top of all that, US Treasury yields remain biased higher. So what does this all mean for us? Well, if those geopolitical tensions actually escalate and this current market complacency shatters, a violent rotation right back into defensive assets is practically inevitable. Which leaves us with one incredibly vital question to ponder today. With oil rising and conflict escalating, how long can this market calm truly last? Thanks for joining me for today's Explainer, and stay sharp out there.